All right. So I welcome you all to this session, which is going to discuss about equity settled share-based payment examples. We are going to start off with our first example, but let me remind you what we studied about equity settled share-based payments. Equity settled share-based payments meant that holders will be settled in the form of shares at the time of their exercise date. The accounting entry is going to be an expense debit and equity option credit. We are going to use fair value at grant dates. That means there will be no mark to market. Now, let us see this question and then we can, move forward. All right. So this is example number 1. And in this example, examiner says that on 1st January X1, an entity grants 100 share options. Now, whenever in a question you see share options written, that means the examiner is talking about equity settled share based payment. On 1st January X1, an entity grants 100 share options for each of its 400 employees. Each grant is conditional. Conditional means that the vesting condition is going to, come up. Each grant is conditional upon the employee working for the entity until 31st December X3. Until 31st December X3 means that they are talking about 3 years, X1, X2 and X3. So the vesting condition is that the 400 employees that are being discussed here, each of them have to work for 3 years in order for them to get some new shares as a share-based payment. All right. So this is a vesting condition. It is a non-market based vesting condition, I would say. And also, if you see that since 3 years have been defined, this is a with service condition question. With service condition questions, that is 3 years have already been defined. Now, since the employees are going to provide benefits to the entity over the period of 3 years, we should recognize an employment expense over the 3 years. That means 1 out of 3, 2 out of 3 and 3 out of 3 expense is going to be recognized each year. Examiner says that the fair value of each share option is $20 at that date, which means this is the fair value at grant date. All right. Now, examiner says during 20x1. During 20x1 means that now we are talking about the first year ended 31st December X1. We are going to talk about the first accounting year. Examiner says that during 31st December X1, 20 employees leave. So you remember we had 400 employees in total, right? Now 20 employees leave. That means actually only 380 are still left. You see, those employees who have left in the first year, they have not stayed for 3 years. So those 20 employees are never going to be eligible for the exercise of this option. So that means to those 20 employees, we have to pay nothing. So at the very least, we have an obligation towards remaining 380 employees. We have to make a share-based payment to them, not to the 20 employees that have already left. But you know what your IFRS 2 says? Your IFRS 2 says that you do not only need to consider those employees who have left in the first year, but you also have to make an assessment that since the vesting period is 3 years, the vesting condition is for 3 years, you also have to make an assessment that how many employees will leave in the entire vesting period. So I'll repeat it again. 400 employees we already had. 20 employees left in the first year. We are talking about X1, sorry. But your IFRS 2 says that it's not only important that you consider the employees that have actually left now. You have to make an assessment that in totality, over the 3-year period, how many employees will leave, and hence how many employees will be remaining by the end of the third year. Because to only those employees who complete the 3-year period, only to those employees you have to make a share based payment, not to the others. So you need to make a wholesome assessment. Now, keeping that in mind, just look at the point again. During 20x1, 20 employees leave, and the entity estimates that 20% of the employees, 20% of the employees. Now, from an examination point of view, you should realize that it's written 20% of the employees. It's not written 20% of remaining employees, not 20% of remaining employees. It's written 20% of the employees will leave during the 3-year period. So your examiner is basically telling you, okay, 20 employees have already left. And if we look at the total picture, we don't look at just year one, we look at the total picture. We believe that 20% labor turnover would be there. That means only 80% employees would be remaining by the end of the 3-year period. So what do we consider? 20% or the 20 employees who have actually left? We consider the whole 3-year period. That is what our obligation is going to be. So if you want to do the accounting of X1, see how we are going to do that. So initially we had 400 employees with us. And although 20 employees have already left, we need to consider the whole 3-year period. And the whole 3-year period is represented by this 20% employees leaving. That means only 80% employees are going to stay. So I took 400 employees, 80% employees will, it's estimated that they will stay, and I'm going to be obliged to them. How am I going to be obliged to them? 400 employees, 80% will be eligible. Each one will have 100 share options in hand. 100 share options in hand. So I multiply it to 100 share options. 400 into 80% is employees. Into 100 SOPs, I get number of SOPs. What is the value of these SOPs? So you see, the examiner gave us fair value at grant date in this question, which is $20. So each SOP is going to be worth $20. So here is my obligation. But one mistake that you may do and you shouldn't be doing is that if you see 400 employees into 80%, there are the eligible employees, each get 100 SOPs with a value of $20, understood till here. But this is a whole 3-year assessment. We are standing at 31st December X1. That means only 1 year has passed. If only 1 year has passed, we can only recognize an expense which is equivalent to 1 year. We cannot recognize the whole SOP expense. Make sense? So what we'll do is we'll multiply this by 1 into 3. We'll multiply this 1 into 3. You remember I just told you this is a with service condition question. If the employee is giving us benefits of employment of the 3-year period, we need to recognize an expense over the 3-year period. So 1 out of 3 expense, that is 1/3 expense, will be booked in year 1. So we'll just calculate it. So it is 400 into 80 into 100 into 20, and we do a divisor of 3. So it's basically $213,333. All right. So what is going to be the accounting entry for this 213,333? We will do expenses debit 213,333 and equity option credit 213,333. Now this is going to be the accounting entry here. So then what? Then we'll go to the next accounting year. We have to continue till the best date arises, till the final date arises. All right. So just look at the second point. During 20x2, we are talking about the next year, a further 25 employees leave. So you remember what was the scenario? It was a question of 3 years. 20 employees have already left in the first year. Look at it, a further 25 employees actually leave the other year. So we have an actual assessment of 2 years. 20 employees and 25 employees, actual assessment is there for 2 years. But you remember what the IFRS 2 just told you? Make an assessment for the whole vesting period. So we need to consider the impact of this third year as well. In other words, we need to consider the whole 3-year period. Now examiner says, and the entity now estimates that 25% of the employees, not the remaining employees, 25% of the employees will leave during the 3-year period. Now, since more employees have actually left in the second year compared to the first year, the entity has revised its estimate for the 3-year period leavers, and now it is 25%. So that means only 75% would be remaining, and we will have an obligation towards only 75% of the people. All right. So how are we going to solve this here? Look very carefully. So in total, we had 400 employees. Now there is an assessment that 25% of the employees will leave. That means 75% will still be there. Each of the employees will get 100 SOPs. So I write it down here. At the end of second year, what will these SOPs be worth? They will still be worth $20. You know why? Because we always take fair value at grant date. We do not revalue. And since we are in the second year, we will do 2 by 3. When we do 2 by 3, we get a cumulative number of 2 periods. That is, we get an as-at number, and that is going to be, let me just calculate it for you guys. So it is 400 into 75 into 100 into 20 into 2 by 3. It is an as-at figure of 400,000. All right. Now, since people, this is an as-at figure, we have to subtract the amount which has already been recognized in the previous year to get already recognized amount of the previous year, which is 213,333. And my friends, that way we will get for the year expense, for the year charge, which is going to be, by the way, 186667. So the accounting entry should be, you should do employment expense debit for the second year 186667. The equity option should be credited by the same amount. And it is fairly obvious that if you look at the second year expense and the first year expense and you accumulate them up, it is going to be 400,000. All right. So the first year's P&L charge was something different. The other year's P&L charge was something different. And if you carefully look, the second year's P&L charge is a bit less. Why? Because now we expect more employees to be leaving. Hence, since more employees are leaving, we'll have to make less payment to the remaining employees. Hence, we have a less expense in the second year. The revision in estimates is basically represented in this estimate here. All right. Now, let's go for the third year. Year ended 31st December X3. Now, if we look at 31st December X3, just look at it, my friends. It's written that during 20x3, a further 10 employees leave. But you see here, your examiner is pretty smart. He's not giving you an assessment of the 3-year period anymore. And why is that? Because no assessment or estimate is now required, because 3 years have gone by. We had 400 employees, 20 left in the first year, 25 left in the second year, 10 left in the third year. So in totality, 55 employees left over the 3-year period. And now we don't need to estimate because we have the actual number. So at the end of year 3, we are very sure that we are only liable to 345 employees only. So the calculation here should be 345 employees, each with 100 SOPs, which is going to be worth for us $20 per SOP, and we'll do 3 by 3 because this is the third year. Now, since we are doing 3 by 3, the third year as that figure we will get. And my friends, this is going to be, I'll just do this calculation, 345 into 100 into 20 into 3 by 3 is 690,000 expense for the 3-year period. For the 3-year period, this is a cumulative as at amount. In order to get the P&L charge, we will subtract less already recognized. How much have we already recognized before this third year? We have recognized an expense of 2 years. Here is one and the other one is here. So we had recognized for about 400,000 till the year before. And that means for the third year, when we have an expense of 290,000, and accounting entry should be employment expense debit 290,000 and equity option credit 290,000. Now, don't you feel this is quite easy? Now, with all the backgrounds that you already have about the accounting standard, I believe these sort of questions won't really pose you a big threat. So this is a very convenient question for you guys. All right, I hope you understand this question. All right. So now let us move on to the next question. We'll do one more example so that we are well versed with this accounting standard. I certainly believe it's not very tough, but still, practice makes a man perfect. Women even more perfect. So example number 2. Here the examiner says that your financial statements have an year end of 31st of December 20x3. And the question starts with 1st January x3. That means it talks about start of the year. It says that on 1st January 20x3, an entity grants 250 share options. Now look here, we are talking about share options. Share options mean that we are talking about equity settled share based payments. All right. So on 1st January 20x3, an entity grants 250 share options to each of its 200 employees. The only condition attached to the grant is that the employees should continue to work for the entity until 31st December 20x6, which means they have a vesting condition of 4 years. And you guessed it right. This is a non-market based vesting condition, and with service condition 4 years service period is identified. Examiner says that 5 employees left during the year. And you see, no further estimate is given for the remaining 4-year period. No further estimate is given. Now we cannot assume ourselves. So in this question, a student should have assumed that the further the employees leaving, the estimate is 0. Because nothing is written. Obviously, when you get a full exam question, you get a particular estimate that actual employees, certain number of employees have actually left, and now further estimate is this and that. But since this is just an example question, you see that 5 employees have left during the year and no further data is given, so that we can clearly assume that the further estimate is 0. It's safe to assume that. Examiner says the market price of each option was $12 on 1st January X3. So $12 is basically the fair value at grant date, right? It talks about 1st January's fair value. 1st January was your grant date. And then it says that $15 on 31st December X3. So that means $15 fair value is also given, which is fair value at 31st December 20X3, which is the reporting date, my friends. So now I ask you, in the case of equity settled share based payments, which fair value do you consider? Grant date or reporting date? Which? You guessed it right. We always consider grant date. All right. So how will you solve this transaction for the year ended 31st December 20X3? You will say that 20 employees were there. 200 employees were there, 20 employees left during the period, and the further estimate is 0. Right, nothing is written, so it's safe to assume that no further employees will leave during in the remaining 3 years to come. Then each of the eligible employees will get 250 share options. It is written here. These share options will be valued at $12. Yes, fair value at grant date. And since we are talking about the first year only out of the 4-year period, then it is going to be 1 out of 4. So now if we calculate, it is 180 into 250 into 12 divided by 4, and this is 135,000. So expense debit 135,000 and equity option credit 135,000 for the first year. All right. So here IFRS 2 is as easy as you can think of it. So it's not very difficult, if I may say. All right. Now, the exam questions are in the same manner. But in order to, have some more idea of what maximum your examiner can talk about, and other paras of IFRS 2, these are not must to know areas, but these are good to know areas. I'll talk about 2 particular paragraphs that are some sort of additional information that may give you an edge under an extreme circumstance if the examiner goes full-fledged into IFRS 2. So 2 paragraphs of IFRS 2 that I want to talk to about is, number 1, that we have to talk about treatment of a reload feature. We need to understand what a reload actually is. And the next is that we are going to talk about what happens in the case of equity settled share based payments after the vest date. So I'll start off with the second area first. It says, having recognized the goods or services received and a corresponding increase in equity. Now these are the original wordings of the accounting standard itself. So it will be of a particular pattern, and you need to respect that. It is of a certain level of difficulty. So having recognized the goods or services received and a corresponding increase in equity, this means that you have made the accounting entry already. The entity shall make no subsequent adjustment to the total equity after the vesting date. This means that IFRS 2 requires that after the vesting date, no accounting for share options after the vest date. All right, there should be no accounting for share options after the vest date. Sir, but we don't understand what will actually happen after the vest date. You see, One was grant date. For example, if I offer my employee share options today, year 0, this will be the grant date. After year 3, it may be the vest date. But vest date do not necessarily mean it is the exercise date. Now the employee may, as per the terms of conditions of the option, may exercise after one more year, that is on year 4. Now the question is, what will we do, what accounting will we do in this period, year 3 till year 4? The accounting standard says no accounting needs to be done, because whole of the expense has been booked till here. Fairly obvious, you had done 3 by 3 till here. Obviously you can't do 4 by 3. It doesn't make any sense. You cannot get 4 out of 3. It is mathematically not possible. So there is no accounting after the vest date. No accounting after the vest date. On the vest date, we know who are our eligible employees, what our expense needs to be. We have already written that in our books of accounts. No further adjustment is required in the case of equity settled share based payments after the vest date. This is very specific to share options. Some other guidelines will be given for cash settled share based payment transactions. So no accounting. You just need to learn this. No accounting after the vest date. All right. Now I'll tell you what your standard says about a reload feature. Now what do you mean by a reload feature? Now there can be a scenario in which, for example, you have an original share-based payment agreement with your employee for 3 years. You say to your employee that if you work for 3 years, I'm going to give you, for example, 1,000 shares as a share-based payment. And there is a good possibility that your existing agreement includes this term, this condition, that if the employee wants, this same contract can be extended for another 3 years, that is, the employee can go to year 6. This is known as a reload feature, right? So extendable agreement in simple terms. Now the question that arises into an accountant's mind is that if a share-based payment agreement contains a reload feature, should we account for this transaction as two share-based payments of 3-year period 1 and 3-year period 2? Should we account for these as two different share-based payments? Or if the reload feature is in the original agreement, it is present in the original agreement, should we account it for as a 1 6-year period share-based payment? How should we do accounting for that? Now for this, there is a specific guidance, there is a specific guideline under IFRS 2. It says that for options with reload feature, the reload feature shall not be considered when estimating the fair value of options granted at the measurement date. This means that even if a share-based payment agreement has a reload feature, the reload feature is not accounted for until and unless it is actually granted. That means the original share-based payment agreement of 3 years would be separately accounted for, and whenever the reload feature is eventually exercised after 3 years, it will be treated as another share-based payment. Reload features are not incorporated at year 0. We will not account for this transaction as a 6-year period share-based payment agreement. All right. So this is what IFRS 2 says about contracts with a reload feature. I hope all of this help you in understanding what equity settled share-based payments are. Just let me know if you have any queries. We will meet you again inshallah in the next class. Thank you.